In 2008, a man in Florida bought a house for $280,000. 3 years later, it was worth $140,000. At the exact same time, another man watched his stock portfolio collapse by almost 50%. Both felt ruined. But 10 years later, one of them quietly became wealthy. And it probably wasn't the one you think. Because when people argue about real estate versus stocks, they usually compare stories. My uncle bought property and retired early. My friend invested in index funds and became a millionaire. But money doesn't care about stories. Money cares about math. And the math behind these two investments is far stranger than most people realize, especially right now, because housing prices are near record highs. Stock markets keep hitting new peaks. Interest rates changed the entire game. And millions of people are asking the same question. If you had to build wealth from scratch today, where would your money actually grow faster? In a house or in the market? The answer sounds obvious until you run the numbers all the way through. Not the Instagram version, the real version. The version with taxes, leverage, crashes, inflation, repair, fear, timing, and 20 years of your life attached to it. Because once you see the actual math, you stop looking at houses and stocks the same way ever again. A strange thing happened in America after World War II. Owning a house stopped being just shelter. It became identity, success, security, adulthood. Governments encouraged it. Banks profited from it. Entire suburbs were built around it. And slowly, one idea became almost sacred. A house is the best investment you can make, which sounds reasonable. After all, homes do go up in value over time, sometimes dramatically. You buy a property. The neighborhood improves. Prices rise. Your equity grows while you sleep. It feels tangible, solid, real. You can touch the walls. You can walk through the kitchen and say, "This is mine." Stocks don't feel like that. Stocks are numbers on a screen. Invisible ownership in companies you'll never visit. One crashes because a CEO said the wrong sentence on an earnings call. Another rises because investors got excited about artificial intelligence for 3 weeks. It feels unstable, abstract, almost fake. And psychologically, humans prefer concrete things. That's why people proudly tell friends they bought a duplex. Nobody brags about purchasing 0.004% ownership in a multinational corporation. But emotionally satisfying does not automatically mean financially superior. And that's where the real story begins. Imagine two people starting at age 30. Same income, same savings, same discipline. One buys a house. The other buys stocks. At first, the homeowner looks smarter. They put 20% down on a $500,000 home. That's $100,000 up front. But here's the magical part everyone loves about real estate: leverage. The bank lends them the remaining $400,000, meaning if the house rises just 10%, the property is now worth $550,000. That's a $50,000 gain on only $100,000 invested. A 50% return. And suddenly, real estate looks unbeatable because leverage magnifies gain. But there's another sentence people say less often. Leverage also magnifies pain. If the same house falls 10%, the owner loses half their equity. And unlike stocks, Real estate has friction everywhere. Closing costs, property taxes, insurance, repairs, maintenance, interest payments. A water heater explodes at 2 a.m. A roof starts leaking. The air conditioner dies in July. And the market doesn't care that you already spent $14,000 replacing plumbing last year. The price is the price. Meanwhile, the stock investor does something painfully boring. They buy an index fund. No tenants, no broken pipes, no calls from contractors, no property tax assessment, just automated investing into businesses spread across the economy. Apple, Microsoft, Johnson & Johnson, thousands of employees working while the investor sleeps. And historically, broad U.S. stock markets have returned roughly 10% annually before inflation over long periods. That sounds smaller than leveraged real estate gains until compounding enters the room, because compounding is where human intuition completely breaks. Here's what most people miss. Real estate feels like it compounds faster because the asset value is large, but stocks compound with extraordinary efficiency. No transaction costs every year, no debt interest dragging performance, no maintenance bleeding cash flow, no giant illiquid asset trapping your money in one location. And over long enough periods, efficiency becomes devastatingly important. Let's do the uncomfortable math. Two investors start with $100,000. One puts it into the stock market, averaging 10% annually. The other uses it as a down payment on a leveraged home appreciating at 4% annually. At first glance, the homeowner seems to win, because leverage boosts returns early. But then, reality slowly starts collecting invoices, mortgage interest, maintenance averaging roughly 1% to 2% annually, property taxes, insurance, selling costs that can eat 6% instantly, periods where home prices stagnate for years, and suddenly the massive gains start shrinking, especially after inflation. Meanwhile, the stock investor keeps compounding uninterrupted, year after year, quietly, boringly, relentlessly. After 30 years at 10%, $100,000 becomes more than $1.7 million. Math _block_widget _always _prefetch _v2. Content A equals P, 1 plus R to the power of T. And that's before adding monthly contributions, which is where the numbers become almost absurd. A person investing $1,000 per month into index funds from age 30 to 60, averaging historical market returns, can end up with several $1 million. Not because they're brilliant, because compounding behaves like a law of physics. Tiny percentages become enormous across decades. But then real estate supporters point to something important: cash flow, rental income. And this is where the debate gets interesting, because a primary residence and an investment property are completely different financial creatures. Your personal home is partly consumption. It gives you shelter, lifestyle, stability, emotional satisfaction. But an investment property is a business, and businesses must survive math. The fantasy version of being a landlord is simple: buy property, collect rent, become wealthy. The real version involves vacancies, repairs, bad tenants, lawsuits, taxes, and neighborhoods changing unexpectedly. Some investors do become extremely rich through real estate, especially those who bought at the right time with cheap debt. That last part matters more than people realize. Cheap debt built modern real estate fortune. For nearly 15 years after the 2008 crisis, interest rates stayed historically low. Money was almost free. Borrowing hundreds of thousands of dollars became normal. And when rates are low, asset prices inflate, homes rise, stocks rise, everything rises. But real estate especially loves cheap credit because the entire industry runs on leverage. Then rates jumped. Suddenly, monthly mortgage payments exploded, and people discovered something uncomfortable. A house price is not really determined by the sticker price. It's determined by the monthly payment buyers can survive. That changes everything. A $500,000 home at 3% interest feels radically different from a $500,000 home at 7%, which means real estate can become trapped. Prices want to rise. Buyers cannot afford payments. Sellers refuse to lower prices. Transactions freeze. Stocks behave differently. They crash faster, recover faster, adapt faster. And psychologically, that speed matters because humans experience volatility asymmetrically. If your stock portfolio falls 30%, you see it instantly. Every day, every hour. The pain is visible. Real estate hides volatility. Most homeowners don't constantly check the market value of their kitchen, so housing feels safer, even when it isn't. During the 2008 housing collapse, trillions in value disappeared. Entire neighborhoods imploded financially. But because homes are illiquid and infrequently priced, the psychological experience felt slower, less immediate. Meanwhile, stock investors panic constantly because prices update every second. Ironically, visibility changes emotional perception more than actual risk. And then there's diversification. This is where stocks quietly become terrifyingly powerful. When you buy one property, you concentrate risk into a single geographic area, one city, one neighborhood, one local economy. If that region declines, your investment declines with it. But broad stock index funds spread risk across entire industries and countries: technology, healthcare, energy, consumer goods, thousands of revenue streams operating simultaneously. A single property can make you rich, but it can also trap you financially for years, especially if your job, your mortgage, and your investment are all tied to the same local economy. And then comes liquidity, the feature nobody appreciates until they desperately need it. Selling stocks takes seconds. Selling real estate can take months, sometimes longer during downturns. And when people need cash urgently, illiquid assets become dangerous. That's why some wealthy people look rich on paper, but remain financially fragile underneath. Their wealth is trapped inside buildings. Then there's the hidden advantage almost nobody talks about: time. Real estate often demands active involvement: searching, negotiating, managing, repairing, refinancing, monitoring tenants, handling problems. Stocks require almost nothing, which means the real comparison isn't just return on capital, it's return on attention.
One of the strangest truths in finance is that many fortunes were built not by constant action, but by long periods of inactivity, buying productive assets, then leaving them alone, which sounds easy until markets crash 40% and every instinct screams to sell. And this is where personality enters the equation, because the better investment is often the one you can psychologically survive. Some people cannot tolerate stock volatility. They panic during crashes, sell at the bottom, re-enter near the top, destroying returns. Real estate protects them from themselves simply because it moves slower. Other people hate debt, hate maintenance, hate being geographically tied down. For them, stocks provide freedom and flexibility that real estate never can. So, which one actually wins? Historically, diversified stock markets have often outperformed residential real estate over very long periods when adjusted for costs, maintenance, and inflation. But that sentence hides something important. Most people never experience the market. They experience themselves, their behavior, their fear, their timing, their leverage, their patience. And leverage is still the reason real estate creates so many visible millionaires. Because when leveraged bets go right, outcomes become dramatic. A homeowner with 5-to-1 leverage can double equity far faster than an unleveraged stock investor. But leverage also creates fragility. A small mistake becomes catastrophic. A vacancy becomes panic. A recession becomes foreclosure. And history is full of people who believed rising property prices were permanent right before disaster arrived. Japan in the 1980s, America before 2008, China more recently. Every bubble sounds rational while it's inflating. That's what makes bubbles dangerous. Meanwhile, stock investors face a different threat. Not collapse, distraction, because markets constantly tempt people to interfere, to chase trends, predict crashes, buy hype, sell fear. And usually, The more activity investors perform, the worse their long-term returns become, which creates an almost absurd conclusion. The most effective investing behavior often feels emotionally unsatisfying. Quiet, patient, unexciting, almost invisible. No dramatic house tours, no renovation videos, no viral social media posts about passive income empires, just decades of disciplined compounding.